What's up, my dear boys and girls? How are you all? Hope you are almost busy with your preparations. I think also you're almost at the end of your preparation as well. Am I right, guys? So to add one more value addition to the student fraternity of CA Inter, here I'm going to provide November 2022 RTP video lecture. This is with related to paper 1. So P5 advanced accounting also I'm going to provide in another video lecture. Fine. Without wasting much time, let me directly entering into the RTP itself. Sir, before dealing with the problems, here I want to emphasize one thing clearly. You know, RTP will cover each and every corner of the entire syllabus. So that's why it is very tough job for anyone to cover the entire RTP in a single video lecture. So by putting such issues in the background, how I am going to deal the entire RTP in a single video lecture. We are not discussing any computation part. We are giving much more emphasis on technicalities which are involved in that particular topic or in that particular question. That means majorly our focus will be towards the concept which is involved in that particular problem. What is the base point in that particular problem, where the students can go into the wrong motion. So such all issues I'm going to discuss. Because the reason is at this stage you already aware all the concepts as well. So why they are providing the RTP themselves? The reason was also whether the students can cope up with the subject or not. Just they can able to check. Okay, no worries. Each and every problem you can very easily understand, and I will correlate whenever there is a particular problem will comes. I'll correlate with our classroom discussion as well. Our classroom notes will also simply I'll put it in the screen. Next. Sir, before checking with the problems, one more thing just I want to discuss. Sir, is there any specific amendment which is applicable, sir, with respect to November 2022 attempt? You know, our paper is P1, which is accounting. There are no much amendments takes place. In fact, there is no amendment at all. The one amendment which was actually there in the year 2021, which was already covered by me in the classroom discussion itself. But still, one more time, just I'm repeating here. That is related to applicability of accounting standards. Related to applicability of AS. You know, to apply the accounting standards to any specific entity, you need to check whether all the accounting standards are applicable or not. For that purpose, the entities were classified into non-corporate entities and corporate entities. In case of corporate entities, there is no amendment. I mean, previously, the provisions which are applicable for corporate entities, the same manner, the provisions are going to continue to apply. But from the year 2021 onwards, the non-corporate entities are categorized into 4 levels: level 1, level 2, level 3, level 4. Earlier, only 3 levels are possible. Right now, one more level, which is level 4, also added. To put it more specific manner, level 1 is related to large, level 2, medium, level 3, small, level 4 or micro. Sir, for which type of entities, which accounting standards are applicable, all such stuff I was already discussed in the main lectures. You can cross verify, or if you want, I'll open the main classroom discussion, what we discussed in our classroom. Just a second. Which is accounting, right? I discussed that part in introduction to accounting standards. If you cross check here, L1, L2, L3, L4 were clearly given. So large, medium, small, and micro. So the turnover and everything was discussed in the classroom itself. That's why there is no discussion about the categorization, just which amendment takes place, just I specified here. Come back. Sir, now out of the problems, which problems now first we will try to cover, sir. Problems related to accounting standards. Let us take it into the discussion first. Come down. Yeah. So this is the problem from AS2, valuation of inventories. All of you please concentrate here. Sir, what the problem is all about, sir? The closing stock of finished goods at a cost of the company amounted to 4,50,000. The following items were included at cost in the total. So the given item was finished goods, FG, which is not the raw material, which is not the work in progress. You know the valuation principle of FG? The measurement principle of FG were cost or NRV, whichever is lower, which is the measurement principle for FG. Now, what the ultimate problem is all about? What should the inventory value be according to AS2 after considering the above items? Now, it was clearly given that the closing stock of the finished good was 4,50,000. Now, after considering these items, what is the real value of the closing stock? Just is asking such point. What is point number A? 100 coats which had a cost of 2,200 each and normally sold for 4,000 each. Owing to a defect in manufacture, their NRV was determined at 50% of their normal selling price. That means cost is at 2,200. NRV is at 50% of the normal selling price, means 4,000 to 50% means 2,000. 2,200 or 2,000, whichever is lower, means at the rate of 2,000. But out of this 4,50,000, the cost value was included at the rate of 2,200. That means you need to reduce 200 rupees per quote. Per quote, 200 means for 100 quotes, 100 into 200, which is equal to 20,000. You need to reduce 20,000 from the cost price. Then only it is showing at NRV. Okay, the first and foremost adjustment was minus 20,000 from the given figure of 4,50,000. Next, coming to point number B, shirts which had cost of 50,000, their NRV value at balance sheet date was 55,000. NRV was directly given. They are giving NRV directly 55, cost 50,000. Cost or NRV, whichever is lower, means they should need to report it cost only, which was already at cost. That's why no need to make any further adjustment. Sir, then commission at the rate of 10% on sales is payable to agents. Na, something was given. Na, can I reduce 55,000 into 10%? That is 5,500 from this 55,000 to get the NRV. No, the given value was not the sales value. The given price itself is net realizable value. That means the cost incurred to realize a specific asset was already reduced. The cost which they incurred to realize the specific inventory was already given. That means this commission, after reduction of this commission, the net realizable value itself is given at 55,000. So 50K or 55K, whichever is lower, means 55K, 50K only. They already included with cost only. That's why no need to make any adjustment. Here you need to understand one thing, guys, before all such things. Now this 4,50,000 is at cost. Now, whenever you are recording inventory at NRV, there may be a chance of adjustment to this cost. If the inventory valuation is still at cost, then no need to adjust this figure. Now, what should be the inventory value, guys? 4,50,000 minus 20,000, which is equal to 4,30,000 is the value of inventory. If you want, you can just cross check the answer with the answer given in the RTP. Just a moment. Yeah. So 4,30,000 is the value of inventory you need to report. That's it. For point number 1, you need to reduce 20,000. For point number 2, no adjustment. Am I right, guys? Next, come back. Problem number 17, which was asked from AS10 property, plant and equipment. So what this problem is all about? RS Limited has acquired a heavy plant at a cost of 2 crore. Okay. The estimated useful life is 10 years. If the estimated useful life is 10 years, means depreciation per annum was how much? Just I'm asking simply. 20 lakhs. Depreciation per annum was 20 lakhs. Okay. Per annum depreciation. At the end of the second year, one of the major components, that is the boiler, has become obsolete, which was acquired at a price of 50 lakhs and requires a replacement, as further maintenance is uneconomical. The remainder of the plant is perfect and is expected to last for the next 8 years. The cost of the new boiler is 60 lakhs. Can the cost of the new boiler be recognized as an asset? And if so, what should be the carrying value of the plant at the end of the second year? Now, the question they are asking from the concept of replacement cost, or I can put it as the concept of component accounting. This is the correct word, component accounting. You know, if you really remember the provisions of accounting standard 10 PPE, if any particular component have the major economic value while comparing with the other components, then for that specific part, you can be treated as separate PPE. Now, that particular component was obsolete due to certain reasons. Now you are going for the replacement of that particular component. At the time of replacement of the particular component, what is the accounting treatment you need to follow? We need to derecognize the old component, as well as we need to recognize the new component into the current PPE. Am I right, guys? Let me open the content what we discussed in the classroom first for better understanding. Just a moment. Go to AS10. Fine. This is all about AS10. Now, coming to the replacement of PPE. In case of replacement of PPE, new part satisfied the recognition criteria, then it should be added to the cost of the PPE, and old part carrying amount need to be derecognized. As on the date of replacement, the old portion carrying amount need to be derecognized, and the new portion purchase price you need to include it in the cost of the PPE, provided such particular part should satisfy the recognition criteria. Sir, what the recognition criteria is all about? When the PPE can be recognized into books of accounts, it should need to satisfy two conditions. If you really remember, then only a PPE can be recognized into books of accounts. The first and foremost condition is it have the capability to generate the economic benefits to the entity, and the cost should be measured reliably. If it satisfied the both the conditions, then you can immediately recognize the PPE into your books of accounts. Now come back to the question, what the question is all about. Can the cost of the new boiler be recognized as an asset? The answer is yes. The answer is yes. You know why? It have the capability to generate the economic benefits, because whenever you are replacing the new component, yes, it have the capability of generate the future economic benefits. And the new cost of the replacement also you can easily measurable. The new cost of the boiler was 60 lakhs. Fine. So that's why first part of the question, yes, we can recognize. And if so, yes, what should be the carrying value of the plant at the end of the second year? Now all of you please concentrate. Initially, it is at 200 lakhs. That is 2 crore. Once they provided the depreciation for the 2 years, 2 into 20 lakhs means 40 lakhs. Before going for the replacement, the carrying amount of the entire PPE was 160 lakhs. Now replacement is going to occur. At the time of replacement, the old carrying amount was derecognized. Old carrying amount means this is the original cost. Out of this, 2 years depreciation was there. So depreciation for 10 years per annum, depreciation 50 lakhs divided by 10 years means, for that particular component I'm talking, 5 lakhs per annum. Am I right? 5 lakhs per annum. That is for 2 years, 10 lakhs. Now 10 lakhs means the carrying amount at the end of the second year was 40 lakhs. Such 40 lakhs you need to derecognize. And you need to recognize the new purchase price, which was 60 lakhs. Now 180 lakhs is the new revised carrying amount. Am I right? Now, what the question is, and if so, what should be the carrying value of the plant at the end of the second year? The carrying value of the plant at the end of the second year was 180 lakhs. That's it. Now let me cross check the answer with my RTP here itself. First, they are talking about the provisions of recognition of an asset. It have the capability to generate certain economic benefits to the entity, and the cost should be measurable. Hence, the item should be recognized as an asset, and the cost of the old boiler should be derecognized and the new boiler will be added. So ultimately, he was given a revised carrying amount was 180 lakhs. That's it. Next, the beauty of the accounting standards is, if you are habituated to apply the provisions of that particular standard to the scenario, you will connect everything. But if you are by hearting the provisions of accounting standard, you may not apply the provisions to a specific scenario. Okay, so please, all of you habituated to improve your applicable mindset or improve your analytical mindset. Okay, fine. Come down to AS11. Just a moment, guys. Fine. A company had imported raw materials worth of $6 lakhs on 5th January 2022, when the exchange rate was 43 per US dollar. Now the question is all about AS11. Let me first directly go with the question, then I'll read the further information. In the background of the relevant accounting standard, is the company's accounting treatment correct? Discuss. Just they're asking about whether the accounting treatment is as per AS11 or not. Okay. We are importing means we are purchasing the raw material from the foreign. Whenever you are purchasing the raw material, entry was purchases account debtor to supplier or the creditor account, whatever the case may be. That is US dollar how much? 6 lakhs. Per US dollar how much? 43. So just I'm recording per US dollar 43. Am I right? Fine. Because supplier is nothing but monetary item. Whenever you are entering into a transaction which related to a foreign currency transaction, in our books of accounts, we need to record at a rate prevailing as on that date of entering into the transaction. Now, as on 5th January, the rate prevailing as on date of entering into the transaction was 43. That's why you need to multiply 43 into 6 lakhs. Just ignore, for only $1 I'm putting here, which was recording at 43. The company had recorded the transaction in the books at the above mentioned rate. That's correct only. The payment for the import transaction was made on 5th April 2022. So this is as on 5th Jan, but the payment should need to made as on 5th April. So in between 31st March is available. Am I right? In between 31st March is available. If it is a monetary item, we should need to revise as on balance sheet date. If you really remember the concept of AS11, if the foreign currency transaction is related to a monetary item, then you should need to check the rate prevailing as on the balance sheet date. Any foreign exchange loss or gain occurred as on that specific date, you can transfer to the P&L account. Now you can check as on 31st March. It was given here, where however on 31st March 2022, the rate of exchange was given at 48. From 43 to 48, it was jumped by 5 rupees, which is a clear-cut loss situation. Now you can treat it as a foreign exchange loss to supplier account, that is at the rate of 48. Just a moment, guys. So I'm so sorry. How much is the foreign exchange loss? Sorry, that is 43 to 48 means 5 rupees is the foreign exchange loss. 5. Am I right, guys? Fine. Now, as on date of payment, what we should need to do? Now, as on date of payment, it was quoted at 47 rupees. Now, supplier account debtor 48. It was shown at 43 plus 5, 48. To bank, it is at the rate of 47. The remaining was gain, which was exchange gain account. This exchange loss we transferred to P&L. This exchange gain we again transferred to P&L. This is the original accounting treatment. But what they did made, let us check. The company passed an entry on 31st March 2022, adjusting the cost of raw materials consumed for the difference between 47 and 43 per US dollar. That's wrong actually, right? As on 31st March 2022, the rate of exchange was 48 per US dollar, means as on 31st March, we need to adjust in between 43 and 48. That is 5 rupees we need to adjust. That is one thing. And one more thing, the difference you should not adjust it with the cost of raw material, because the purchase cost was fixed at 43. The difference you need to adjust with the supplier, that foreign exchange loss to supplier account, because the amount need to make payment to the supplier will increase due to fluctuation in the foreign exchange rate. You should not disturb the purchases. The company passed an entry on 31st March 2022 adjusting the cost of raw material itself is wrong, and that too they should not consider this difference as well. That's why the accounting treatment followed by such company is not at all relevant as per accounting standard 11. Sir, then how can we draft the answer for that particular question, sir? As per accounting standard 11, if an entity is entered into a foreign exchange currency transaction, if it is related to the monetary item, we should need to revise such monetary item as on the balance sheet date. And the foreign exchange gain or loss occurred as on such balance sheet date, you should need to transfer to the profit and loss account by treating it as a foreign exchange loss and gain by adjusting the such monetary item. But in the given case, company adjusted such a loss into the raw material cost. That too, they are not comparing the rate prevailing as on date of entering into the transaction and rate prevailing as on balance sheet date. They compared the different rates as well. That is the answer. Let me cross check the answer with RTP. What they are given. Sir, trade payables is a monetary item. That is, supplier is a monetary item. Hence, should be valued at the closing rate at 48 at 31st March 2022, irrespective of the payment for the same subsequently at a lower rate in the next financial year. So the difference between 48 minus 43, which is 5 rupees per US dollar, should be shown as an exchange loss in the profit and loss account for the year ended 31st March 2022. And also, it should not be adjusted against the cost of raw material. It should be adjusted against the supplier. That's correct. In subsequent year, the company would record an exchange gain of 1 rupee per US dollar. That is the difference between 48 and 47 per US dollar. Hence, the accounting treatment adopted by the company is incorrect. That's it, guys. Come back. Almost 3 questions over. Now, let us have a look into AS12, guys. Accounting for government grants. Samrat Limited has set up its business in a designated backward area, okay, which entitles the company for subsidy of 25% of the total investment from the government of India. If you invest 1 rupee, out of which 25% is 0.25 paisa was directly given as subsidy by the government of India. The reason was you are established your entity in the backward area. If government of India provided this type of subsidy, you know, such type of government grant is known as promoter's contribution. Am I right, guys? Hope you are with me. I'll open the type of government grants. 1 second, just a moment. Let me open the classroom notes for AS12. Fine. Now, promoter's contribution for startup of new businesses. Am I right? Business entity receive the government grant for startup of their business and no need to return back after making investment. Then such type of government grants are treated as capital reserves. Fine. Come back to the question. What the question is all about. The company is eligible for subsidy and has received 20 crores from the government in February 2022. The company wants to recognize the said subsidy as its income to improve the bottom line of the company. Income, just they want to treat it as income in the P&L. Income means that is income in the P&L. Is it correct? No, it should be read as capital reserve. Do you approve the action of the company in accordance with the accounting standard? No. So the treatment done by the Samrat Limited was against the provisions of AS12 because whenever it got the subsidiary in the form of a promoter's contribution, it no need to reback to the government because government provided this assistance as a result of establishing your entity in the backward area. So that's why the entire amount of 20 crores, you can clearly treat it as a capital profit and transfer to the capital reserve. Such amount will not be available for distribution of the dividend. That's it. Come back to AS13 accounting for investments. So what the question is all about, reclassification of investments. Remember guys, almost the reclassification of investments concept was given in multiple times in the examination. This is important. Whenever they're asking a question from AS13, always they are picking the question from reclassification. I don't know the reason as well. The reason may be the students might confuse the reclassification provisions whenever they're applying for long term to current and current to long term. The provisions are pretty much easy. What are the provisions for reclassification? If the reclassification are happened from current to long term, now at which value I need to reclassify? The long term means, oh sorry, that is current to long term and long term to current. So then first, sir, if it is current to long term means in future you will never get a chance to compare cost with fair value, because if the investment is a current investment, you should always value the current investments at cost or market value, whichever is lower. That market value is nothing but fair value. That's why at least you can take a chance to value the investments right now by comparing the fair value with the cost. Whichever is lower at that price, you can carry forward. That means current to long term means investment should need to value at cost or fair value, whichever is low. Now coming to long term to current means in future you are having a chance. In future you may get a chance to compare the cost with fair value. That's why at this instance you can compare the cost with carrying amount, cost or carrying amount, whichever is lower. Okay. Now coming to the questions, total they are giving the 3 scenarios. If you observe, in each and every scenario we need to check at which value as on balance sheet date we need to report such investments. A portion of current investments purchased for 25 lakhs cost reclassified as long term, that is current to long term. As the company has decided to retain them, the market value as on the date of balance sheet was 30 lakhs. You can consider it as a fair value. The fair value of the investments on the date of transfer is same as the market value. We can consider the fair value as market value. Then 25 lakhs or 30 lakhs, whichever is lower, that is at 25 lakhs, at the rate of 25 lakhs. Come to point number 2. Another portion of current investments purchased for 20 lakhs, which was cost, has to be reclassified as long-term investment. The fair value of these investments as on the date of balance sheet was 12.5. Cost or fair value, whichever is lower, means investment should be valued at the rate of 12.5 lakhs by providing loss at the rate of 7.5 lakh. Such loss you can transfer to P&L because the original cost was 20 lakhs. Now you need to provide one entry P&L to investment account at the rate of 7.5 lakh. Automatically the cost will be decreased to the extent of 7.5 lakh. Then in the books of accounts, the investments are going to shown at 12.5 lakh. Come to point number 3. One portion of long-term investments no longer considered for holding purpose to be reclassified as current investments. Long-term to current, cost or carrying amount, whichever is lower. So cost, the original cost was 15 lakhs but had written down to 11 lakhs to recognize the permanent decline as per AS13, which was a carrying amount. 15 lakhs or 11 lakhs, whichever is lower, that is at the rate of 11 lakhs. It was already carried at 11 lakhs. That's why no need to recognize any loss right now, which was already written down to 11 lakhs in books of accounts. Earlier in the past, there is a due to permanent decline in the value of investment, which was carried at 11 lakhs, but the original cost was 15 lakhs. Now 15 or 11 lakhs, whichever is lower, means just you can shown at the rate of 11 lakhs. That's it, guys. Next, come to a 16 problem, which is problem number 20, which is the last problem in accounting standard, guys. Hari's construction company is constructing a huge building project. First, let me check what is the requirement. The requirement is find out the total amount to be capitalized and to be expensed during the year. Just they required one thing. How much amount to be capitalized, how much is treated as revenue expenditure. We know only one thing related to the borrowing cost. Borrowing cost incurred on any qualifying asset up to the date of ready for use of the particular qualifying asset. The entire borrowing cost we need to be capitalized. Any further borrowing cost incurred on that particular qualifying asset should be expensed. Number one, you need to check whether it is qualifying asset or not. Whether it is qualifying asset or not. If it is qualifying asset, first please check all of you. If it is not a qualifying asset, straight away expensed. Fine. If it is a qualifying asset, up to date of ready for usage, not put to use, capitalization process should be continued. But once the asset is ready for usage, if you incurred any borrowing cost, it should be expensed. All such issues were discussed. Now what this is all about, let us have a look. So Hari's construction company is constructing a huge building project consisting of 4 phases. It is expected that the full building will be constructed over several years, but phase 1 and phase 2 of the building will be started as soon as they are completed. In general, practically how this is happening, in metro cities, the construction companies are going to construct blocks actually. Maybe that is a gated community. They may be constructed 2 blocks. They are readily available within 2 years. And once such blocks construction completed, then the remaining other 2 blocks may they start. Or at the time of construction, these 2 blocks, the other 2 blocks construction is also going on, but they might completed after taking much more years. Do you agree? Do you understand? Simply is telling that out of the 4 phases, 2 phases are readily available, or they may be completed very soon. The remaining 2 phases, it will take much more time. Okay. Phase 1, phase 2, phase 3, phase 4, total expenditure was given, which was given total expenditure of all phases was 221. Loan taken at the rate of 15% at the beginning of the year was 200. Now the question is, now the further information is during the mid of the current year, phase 1 and phase 2 have become operational. Okay. Find out the total amount to be capitalized and to be expensed during the year. One thing is sure, guys. For phase 3, phase 4, whatever the interest they incurred, they should be capitalized straight away, because those were not completed, not in operational. Coming to phase 1 and phase 2, interest only off the period, off of the interest capitalized. Why? Those were operational at the mid of the current year. Mid of the current year means for 6 months itself the asset was ready for use. The qualifying asset is ready for use. The remaining off of the interest should be expensed. Now, the point is how much interest they incurred for phase 1 and phase 2 put together. The loan amount was 200 lakhs, right? 200 into 15%. The total interest amount was 30 lakhs. The total interest was 30 lakhs. Out of which, for phase 1 and 2, how much? For phase 3 and 4, how much? First, you need to check. In the proportion of cost only, we need to distribute this interest cost as well. For phase 1, 34 plus 64. Total 58 lakhs cost incurred. For phase 3 and 4 put together, 55 plus 68. 123 lakhs they incurred. Now, in the ratio of 58 lakhs is to 123 lakhs, you need to distribute this 30 lakhs interest expense. Now, 30 lakhs into 58 divided by 123. This is 14.146 lakhs for phase 1 and 2. For phase 1 and 2, the interest expenses for total interest expenses for 14.146 lakhs. Guys, this is for the entire 12 months. This is for the entire 12 months. But of the interest expenses need to be capitalized, remaining off should be transferred to P&L. Out of this, 50% is capitalized. Remaining 50% is transferred to P&L. Sir, what about phase 3 and 4 related interest? That is 30 lakhs minus 14.14 lakhs. That is 15.86 lakhs entire capitalized. Now from this, the entire information only, that is around 7.7 lakhs only transferred to the P&L, and the remaining interest, the remaining entire interest expenses should be capitalized. Find out the total amount to be capitalized and expensed during the year. Let me cross check the answer with RTP. Concentrate. So interest on phase 1 and 2, how much they got? One second, guys. This is 98, not 58. I'm so sorry. This is 98. 34 plus 64 is 98. Nah? Now the ratio, this amount was wrong. I'm so sorry. How much this is? 30 lakhs into 98 divided by 98 plus 123. So there is a computation wrong earlier. That is 221. I'm so sorry. 30 into 98 by 221, which is 13.30, guys, which is 13.30. If it is 13.30 and the remaining will be 30 minus 13.30, which is 16.7. Now out of which 50% is capitalized, 50% is treated as P&L. There is no change in the concept. Concept is same, just there is a computation issue. Now you can cross check for phase 1 and phase 2, 13,30,317. For phase 3 and phase 4, 16,69,683. This entire amount was capitalized. Out of this, 50% is capitalized, 50% is transferred to the P&L. The same was given here. If you observe, for phase 1 and 2, 50% is 6,65,158 of the amount should be expensed and the remaining off should be capitalized. For phase 3 and phase 4, still they are under the work in progress. That's why entire amount was capitalized. Even single rupee no need to expense, has not been completed yet. So that's why entire amount should be capitalized. Fine. This is all about AS 16th problem, guys. Hope we successfully completed problems based on accounting standards. Now let us have a discussion regarding the other problems, guys. Concentrate. Guys, this problem is related to preparation of financial statement, which is problem number 1, related to preparation of statement of P&L balance sheet. So numerous problems we have done in our lectures with respect to preparation of statement of P&L as well as preparation of balance sheet. Now in the first problem, the requirement is also prepare the company's statement of P&L as well as company's balance sheet as on that date. Just as a matter of discussion, I will check the summary only. I don't want to give much space, or I don't want to provide the in detail discussion with respect to this problem. Now, the following balances appeared in the books of Oliva Limited. These are both the assets, liabilities, incomes, expenses, all the information, which is simply, you can call it as also TB, trial balance. How you know, sir? Because if you check inventory, opening stock was given, raw material, finished goods, purchases of raw material was given, manufacturing expenses, salaries and wages, general charges, building, plant and machinery, furniture, motor vehicles, investments, both current and non-current investments were given, trade receivables, cash in bank. It includes both the assets and expenses having debit balance. These all are having debit balance. Now, the trial balance was given in different structure actually. So we can easily understand from the given information. Sales, this is all about credit balances, interest, P&L, share capital, loan, short-term, long-term, fixed deposits. Sir, fixed deposits are in generally assets for any entity, but these are deposits taken from the public by the company. So that's why it was shown as a credit balance. You can also treat it as liabilities only, short term, long term, and trade payables for given. What is the further information? Closing stock of raw material and finished goods both are given, which is as a closing stock. Related to manufacturing and salaries and wages, outstanding expenses are there. Interest accrued on securities are available. Investments is there na? Under investments, interest accrued, which is an asset. General charges prepaid, which is prepaid expenses, again asset. Prepaid expenses is an asset. Accrued income is an asset. Sir, where we should need to represent all these assets, guys? Outstanding expenses is a liability, right? The liability we should note is shown under current liability, under current liabilities, other current liabilities. So these both the assets you can show under current assets, under other current assets. That is the correct head of outstanding expenses and income, accrued and prepaid expenses. All are given. Next, provide depreciation for various assets. Current maturity of the long-term loan. Super beauty. The beauty of the problem is point number 6, you know. Sir, if you really seen my previous RTP lectures, in the previous RTP, I concluded one amendment. What is that amendment? That amendment also with respect to Schedule 3. Current maturities of the long-term debts were now shown under short-term borrowings. Earlier, current maturities of the long-term borrowings were shown under other current liabilities. What this is all about, sir? The clear-cut explanation was already given by me. Current maturity of the long-term loan means, for example, if you issued the debentures, the debentures maturity period was total, just a moment. You issued the debentures for 5 lakhs. Out of such 5 lakhs, 50% you are going to redeem after an year or after 2 years, let us assume, after 2 years. And the remaining portion you are going to redeem after 4 years. Now, at the end of the first year, within the 12 months, half of the amount you are going to redeem, right? Such 2.5 lakh, such half of the amount you can call it as current maturity of the long-term loan. Current maturity of the long-term loan means at the end of a specific accounting period, you need to check within 12 months period how much long-term loan amount is going to repay. Such amount is known as current maturity of the long-term loan. As on that balance sheet date, the current maturity of the long-term loan, right now we should need to treat it as a short-term borrowing. Earlier it was shown under other current liabilities. That means out of this long-term loan, where it is there long-term loan here, out of this 21,000, 1,000 you can show under short-term borrowings. The remaining 20,000 only you can show under a long-term borrowings. That is the point he's emphasizing through point number 6. This is the highlight point for the entire problem. The taxation provision of 40% of the net profit is considered. If you know PBT, then 40% is the provision for tax. Fine, guys. This is all about entire information. Then I should need to prepare statement of P&L as well as balance sheet. You know the format of statement of P&L. You can start with revenue from operations. Revenue from operations means sales, which are at 17,10,000. I'll open the answer as well simultaneously. Just a moment. Come down. Fine. Come to statement of P&L, all of you. This is related to statement of P&L. So 17,10,000 is the revenue from operations. Then other income is also available. Interest is given at 3,900 plus another income is also there. Just a moment. What is that? Here it was given interest accrued on securities, which was also 300. Interest accrued means what is the entry? Interest accrued accounted are to interest account. That's why this 300 rupees should also be considered in P&L. So 300 plus this interest 3,900, total 4,200 was given under other income. Then coming to expenses, you can start with raw material consumed. Opening stock of raw material 30,000 plus purchases of raw material 12,60,000 minus closing stock of the raw material, which is 25,800. You can take it as a cost of raw material consumed, which is cost of raw material consumed. You can go to the note number 10, then which is opening plus Purchases minus closing will come. Opening plus purchases minus closing will come. Next, after cost of raw material consumed, you need to cross check the opening stock in trade with closing stock in trade. I mean, opening finished good and with closing finished good, it was clearly given opening finished good is at 46,500 and a closing finished good is at 60,000. The difference is 15,000, which is known as change in finished goods or stock in trade, like that. Am I right? Which is changes in inventories of finished goods, work in progress, and stock in trade. So such change was given. Am I right? There is no purchases involved. So the change, it was how much, guys? 60,000 minus 46,500, which is 13,500. Now here closing is more than the opening. Here the closing is more than the opening. That's why the expense part should need to decrease. That's why the symbol was given as a negative. Am I right? Do you agree? Opening minus closing, it become negative. Negative means there is a decrease in expense. Fine. Next, employee benefit expenses, finance cost, depreciation and amortization, then other expenses. Now come employee benefit expenses, salaries and wages are available. If you check here, certain outstanding and prepaid is also available. Where salaries and wages outstanding 4,500 is there. So you can add 4,500 to this, which is employee benefit expenses. Depreciation portion was completely given here. The total depreciation you can work out. There you can put depreciation and amortization. Then finance cost, the interest cost. Anywhere given finance cost. I think so. There is no finance cost involved here. Then the remaining expenses, manufacturing expenses, general charges. Consider the prepaid as well as outstanding in the adjustment is coming under other expenses. The same was given employee benefit expenses after adding the outstanding expenses. Finance cost, as I told, nil. Depreciation and amortization, given the adjustment in that particular point, you can make it total. Then you will get other expenses, which are note number 13, which includes manufacturing as well as general charges. Please check it. Other expenses. Manufacturing, general charges. General charges prepaid are there. That's why reduced. Manufacturing expenses, certain expenses are outstanding is there. That's why they added. Those are the common adjustment. I don't want to provide any detailed discussion here. Hope you know. This is all about the statement of P&L. Then come to the balance sheet. Then find the profit or loss first. Then find the profit or loss. Profit before exceptional, extraordinary items and tax. Then there is no extraordinary items, there are no exceptional items. Then you can directly come to the profit before tax. It was clearly given that 40% as provision for tax. That's why the tax expenses you can reduce for 40%. Remaining 60% will be carry forward to the reserves and surplus. Then come to the balance sheet, guys. Under the balance sheet, we'll start with share capital. Share capital was directly given. Under reserves and surplus, only two items will come. That to one item only will come. There are no other reserves. Only surplus is there. Accumulated profits 21,000 plus current year profit 29,430. If you make it add both, 50,430 is the reserves and surplus balance that was given here. Reserves and surplus. Next, long-term borrowings, guys. Here 21,000. Out of 21,000, we reduced 1,000 as a current maturity of the long-term debt. That's why 20,000 plus under fixed deposit 3,300 is there. 3,300 total 23,300. That is about the long-term borrowings. Next, coming to current liabilities, guys. Short-term borrowing. Sir, just now I told you out of this long-term borrowings 21,000, 1,000 will be treated as current maturities of the long-term debts. This 1,000 plus here short-term 4,500 plus 1,500. 4,500 plus 1,500. 6,000 plus 1,000, total 7,000. Do you understand? Are you with me? Next, trade payables directly given, guys. 3,27,000, make it as it is. Provision, short-term provision for tax is there. Just now we work out in the statement of P&L. Provision for tax is 19,620. Put the same figure here, 19,620. Next, other current liabilities. So many things will come. Outstanding expenses, where you can put here, where you can need to show, that is under other current liabilities. If I open note number 4, all are outstanding expenses only. I'll show here, just a second. Expenses payable, which are manufacturing expenses, something Just come down. Yeah. Outstanding manufacturing expenses 67,500, 4,500 outstanding salaries and wages. Those were shown under other current liabilities. That is all about current liabilities, guys. Then come to assets. PPU you can work out after providing depreciation, how much amount it will come, you can put here. Then you can treat the given investment as a non-current investment directly. Sorry, non-current are there, current are there. Put the non-current investments here, which are 7,500. Next, current investments. There is no other item in the non-current assets like intangible assets and all that stuff. Nothing is there. Then current investments you can put 4,500. Then inventory closing stock information was directly given. You can make it add, that is 85,800 something. Trade receivables information was directly given. Cash and cash equivalents information was also directly given. The one and only important item was other current assets. Under other current assets, prepaid expenses will come. Tell me, guys, prepaid expenses is there, na? That will come. Or any other current asset is there apart from that? Interest accrued is there, na? Interest accrued, 300 rupees interest accrued. So these two will come under current assets, under other current assets. That is all about balance sheet. In very layman approach, in very quick mode, just I summarized the financial statements preparation, including statement of P&L as well as balance sheet under Schedule 3 format. Then come down, guys. Question number 2 is related to managerial remuneration. Now my question is, managerial remuneration is completely depending upon whether the company is having the sufficient profits or not. If the company is having the sufficient profits, you know the structure, the maximum 11% of the net profits, and individually the percentage might vary. If the company is not having the adequate profits or there no profits, then managerial remuneration is based on effective capital concept. Tell me, guys. Now, in the given question, let me check what they are asking. You are required to compute effective capital as per the provisions of Schedule 5 of the Companies Act 2013. Sir, how we need to calculate the effective capital? We already seen through financial statements of companies chapter. Let me open my notes for a quick glance. Yeah. Sir, in case of effective capital concept, what are all different components you can include, sir? Paid up share capital, you can include all the reserves and surplus, but we should not include the revenue reserve. You should exclude the revenue reserve. You can include the long-term borrowings as well. You can reduce the accumulated losses and the preliminary expenses not written off. You can reduce the investment as well if the company is other than investing company. If the company is an investment company, then you should not reduce such investment as well. Am I right? With this base information, let me work out the effective capital in this problem, guys. Sir, can I consider the share capital? Yes. Capital reserves 1,75,000 is revaluation reserve. Out of this 2 lakhs, you can consider only 25,000 then. Sir, securities premium. Yes, any reserves and surplus you can include except revaluation reserve. Long-term debt. I can include, sir, long-term debt. I can include, yes. Investment in shares and debentures. You need to reduce the investments, fine. P&L account debit balance, you need to reduce. Then automatically you will get the effective capital. That's it. This is all about problem number 2. Then the next problem is from cash flow statement. The concept is pretty much important. You know, regularly they are testing question from the cash flow statements. Guys, cheer up and pull up your energy and let us have a good discussion on this problem, cash flow statement. So what this problem is all about, first what they required. Prepare the cash flow statement for the year ended 31st March 2022 as AS3 revised using indirect method. You know, in case of indirect method, cash flow from operating activities discussion only impacted. That is, whether you are using direct or indirect, cash flow from investing and financing, there is no impact. In case of indirect method, how you need to start? That is, if the given information is PAT, profit after tax, then you can add back the provision for tax, then you will get the PBT. Am I right? From where you need to adjust non-cash and non-operating activities. What is the reason? What is the reason, guys? we are in computation of operating activities. Out of this profit, if any non-operating expenses or non-operating incomes are clubbed, we should need to exclude. If it is the non-operating expense, you can add. If it is a non-operating income, you can reduce. As well as you are working the cash flow, so that's when non-cash expenses like any depreciation, other components are there, you need to add back as well. Then you will get cash generated from operations before adjusting working capital items. Then you need to adjust the working capital items like current assets and current liabilities. Sir, if there is any decrease in the current liabilities, cash outflow. If there is any increase in the current liabilities, cash inflow. If it is related to current assets, if there is any increase in the current assets, cash outflow. If there is any decrease in the cash if there is any decrease in the current assets, then you can treat it as a cash inflow. Like this, you need to conclude. Then you will get cash flows from operating activities before taxes. Then you need to reduce taxes paid. That is very much important. Then you will get cash flow from operating activities. This is the structure of indirect methodology. You know, cash flow from investing and financing, and that is not much difficult as well. That is related to any particular fixed assets purchase and sale. Then you can categorize it as under investment. And related to financing, which is procurement of finance and the repayment finance activities are there, then you can treat it as a financing activities. Fine. And under the investing activities, the investments and the dividend received on such investments and all other stuff also included. In detail discussion was already we made in the lectures. Now, with this information, first what I should need to check, sir. First, let us have a quick glance on the problem. Balance sheet was given, which is the balance sheet of Max Limited for the year ending 31st March 2022 and 31st March 2021 were summarized. 2 years balance sheet information was given, which is the last year information, which is the current year information. As usual, equity, share capital, reserves and surplus, trade payable, short-term provision, PPE, long-term investments, inventory, trade receivable, cash and bank. Under notes to accounts, reserves and surplus, P&L was given. 2021 8,000, 2022 9,000. Okay. Provision for income tax was given. Under short-term provision, PPE building is 1 PPE, furniture and fixtures and cars are also available. Okay. The profit and loss statement for the year ended 31st March 2022 as disclosed. Profit before tax was 8,000. Income tax was 7,000. Profit after tax was 1,000. This is the required information for me. PBT was directly available. Profit before tax was 8,000. If they are given PAT, if you added the tax, then you will get PBT. PBT information itself is there. Then you can start with directly PBT. That is profit before tax. You can start. How much was given? 8,000. Okay, first let me read the further information as well. Depreciation on building for the year was given. Depreciation on furniture and fixtures was given. Depreciation on cars for the year was 5,000. One car was disposed during the year for 3,400, whose written on value was 2,000. Okay, fine. Next, purchases, investments were given. Sold investments, and these investments costed 2,000 was given. This is the further information. Now, first, let us work out the operating activities quickly, guys. PBT was given, which is 8,000, right? We need to adjust non-operating and non-cash items. First, all these depreciation components you need to adjust. All the depreciation components. Non-operating items. What are the non-operating items, sir? One car was sold out, na? One car was disposed during the year for 3,400, whose written down value was 2,000. 2,000 cost of the car sold at 3,400 means 1,400 profit is there. Such 1,400 profit was included here. Now you need to reduce as an operating, non-operating income. One more thing, investments sold for 10,000. These investment cost was 2,000. Now again there is a 8,000 profit is involved here, which is non-operating income. You need to adjust minus 800. So the depreciation component added, non-operating incomes you should need to reduce. Now let me have a discussion with the answer directly, guys. Just a moment. Yes. So they started directly with PBT. They added the entire depreciation, profit on sale of investment they reduced, profit on sale of car also they reduced. Then they got operating profit before working capital changes. Now start discussion on the working capital items. Working capital items means current asset and current liability. Come up. First, let us have a discussion on current liabilities. Trade payables 5,000 to 8,000 increase. Add short-term provision. Which short-term provision you should not consider here, because short-term provision is related to provision for tax. So related to tax, separate discussion. You should never combine the provision for tax item with the working capital changes. The reason was tax component we are adjusting separately. Fine. Come to the current assets. 8,000 to 14,000 increase in inventory means you need to reduce. 6 to 8 means again reduce. Cash and bank also you should need to touch, because the entire cash flow statement is only we are working to compare this cash only. The cash and cash equivalent we are adjusting at the final step of the cash flow statement to know the reconcile. After making the reconcile, to know the closing cash balances. Am I right? So that's why don't consider this one as well. Now, if you cross check here, increase in trade receivables, increase in inventory, both are reduced. I also told you the difference amount should be minus. The difference should be reduced. And one more thing, increase in trade payables, 3,000 added. I also told the same part. Cash generated from operations you will get. Then less taxes paid. From the given information, you can cross check, guys, how much taxes paid here. Please all of you concentrate. Sir, in the last year, provision for tax was 4,000. In the current year, provision for tax was 7,000, which is the balance of 7,000. Is it entire 7,000? It is created in the current year, or how much out of this 7,000, how much created in the current year? It was clearly given below. If you observe, income tax which was provided in the current year was 7,000. That means the entire 7,000 is related to current year only. That means in the current year, P&L2 provision for tax. In the last year books, they might provided P&L2 provision for tax. Now the last year is the previous year. The current year is the assessment year. What you estimated in the last year, now you are going to pay in the current year as per the income tax system in India. Now this 4,000 you need to pay. Or if you have any doubt, you can open the provision for tax account. Opening balance was 4,000 and the closing balance became 7,000. How the closing balance became 7,000? If you paid this 4,000 in the current year to bank, then in the current year you might created by P&L 7,000. Some persons may have a doubt that, sir, why you can think like that, sir? Opening 4,000 is there, na? Sir, we created in the current year 3,000, na? Like that you can think, sir. If that is the case, if they are created only 3,000 in the current year, then why they reduced to 7,000? That means they are not created in the current year 3,000, they created 7,000. That is the reason why in the P&L account they reduced to 7,000, na? That means in 7,000 is there in P&L account means they created 7,000 provision in the current year. So that's why P&L to provision for tax 7,000. The entire 4,000 was paid in the current year. So that's why the taxes paid was related to the last year provision simply. The 4,000 amount got reduced. Then they got net cash from operating activities. Then investing activities, pretty much easy, guys. Quickly, all of you. Come to point number 4, purchase of investment, cash outflow, sold investments for 10,000, cash inflow, outflow. One more thing, check the fixed assets, guys, all of you. Cars, something was given 16 to 25. That means some purchase and selling something was happened. Na? That one also you can consider. One car was disposed during the year for 3,400. Cash inflow. This is also an investing activity. One more thing, we need to cross check any car other than this disposal of the car, any other transaction was occurred or not, we need to check. Please concentrate. It was given that depreciation on cars for the year was 5,000, right? If the depreciation was 5,000, just a moment. If the depreciation was 5,000, then 16,000 minus 5,000, it should become as 11,000. It should become as 11,000. Apart from that, One car was also disposed, which was 2000 minus 2000. That means 9000 is the WDV at the end of the last year. Or I'm sorry, at the end of the current year before providing the depreciation. But how 9000 will become 25,000? That means you might purchase some car. Do you understand? Sir, last year closing WDV 16,000, sir. Current year depreciation 5,000, sir. Current year disposal 2,000 original cost, sir. Then the closing WDV should be 9,000. Nah? Then how it will become 25,000? Somewhere some car you purchased. How much, sir? 11 plus 5, 16,000 worth of car purchased. That 16,000 of car is investing activity outflow. Now let us have a look. Investment cash flows. Sale of car inflow 3,400. I also told you. Purchase of car 16,000. Just now I found. Sir, whenever you have any question of mind regarding such issues, you can simply open that car account. Then everything will come into the picture. And it is my sincere request, all of you open that specific account in the problem as well. Then only they will awarded the full marks. Just I'm in the process of summarizing the things. That's why I'm not providing any particular account. Just I am telling by seeing the information itself. Hope you are following. Next, purchase of investment 6,000. Yes, I also work out. Sold of investment 10,000. Where it is sale of investment. Yes, I also considered. And one more, just I seen only one fixed asset, which was car. Let us have a look into furniture and fixture. How furniture and fixture will become 22 to 34,000. You might purchase something 12,000 worth. How much? Sorry, the difference is how much? 8 plus opening. Opening is 22,000. Just a moment. Depreciation on furniture and fixtures was 2,000 minus 2,000. So closing should be 20,000, but the closing was 34,000 was given. That means how much you purchased in the current year? 14,000 was purchased in the current year. Now building 20,000, current year depreciation 1,000. That's why it became 19,000. Nothing was purchased related to the building. If you want, you can cross check for the building depreciation 1,000. So that's why the only impact on the furniture and fixtures, you purchased 14,000, which was an outflow. That's it, guys. Next, related to financing activities. Just a moment. First, equity share capital. How 1 lakh become 1,20,000? You might issue 20,000 worth of shares, which is financing activity, cash inflow. Any dividend payment, something is there. Any interest payment, something is there. Nothing. I think so. There is only one activity is possible related to financing. Issues of shares for cash inflow. Then net decrease in cash and cash equivalent you got. Then add opening cash and cash equivalent. Then automatically you will get closing cash and cash equivalents. Working notes, everything they provided. Simply. Okay. So this is all about cash flow statement, guys. Friends, actually, at the beginning of my session, I told you my plan is I want to cover the entire content in one video lecture, but I know it is not possible. Let us give a good break at this point of time. The remaining questions, which are from profit or loss plain post incorporation, bonus and right shares, redemption of preference shares, redemption of debentures, then departmental accounts, branch accounts, insurance claims, hire purchase, all such stuff we are going to discuss through next video lecture. Until bye, have a good day. Hi guys, this is the continuation to the last lecture what we have done. That is, the last lecture we covered problems related to all accounting standards as well as finance statements of companies, that is preparation of statement of P&L as well as balance sheet, and cash flow statement also over. Am I right? Now this is the time for the other chapters. So the first and foremost problem for today's session is profit or loss prior to incorporation. Guys, whenever a question asked in the examination from this chapter is no doubt about it, that is pocket marks only. Very simple questions they are asking, and the concept is also pretty much easy. Now what they're asking, prepare a statement showing the calculation of profits for the pre-incorporation and post-incorporation periods. Now, the promoters of Shiva Limited took over on behalf of the company running business with effect from 1st April 2021, which is date of incorporation, 1/4/2021, DOI. The company got incorporated on, I'm so sorry, this is date of, not date of incorporation, this is date of takeover of the business. The company got incorporated on 1st August 2021. 1st August means 1/8 2021. The annual accounts were made up to 31st March. This is the closure, 31st March 2022. Now my question is, what is the pre-incorporation period? How much here is the pre-incorporation period? This is the pre-incorporation period. Exactly April, May, June, July. That is for 4 months. And the remaining 8 months will be the post-incorporation period. That is August, September, October, November, December, Jan, Feb, March. Now the time ratio is 1:2. Time ratio is 1:2. Fine. Next. The annual accounts were made up to the March 31st, 2022, which revealed that the sales for the whole year total 24 lakhs, out of which sales till 31st July 2021 were 6 lakhs. Now the pre-incorporation period sales are 6 lakhs, then the post-incorporation period sales were 18 lakhs, then the sales ratio will be 1:3. Okay, fine. These are the two information we need to put in our mind before proceeding with the problem. And gross profit was 20%. So the sales were 24. 24 into 20% means 24 into 20%. The GP is 4.8 lakhs actually. The gross profit was 4.8 lakhs. Because sales into GP percentage means gross profit. This gross profit you need to distribute in sales ratio, that is 1:3, in between pre and post. Salaries time ratio, rent, rates and insurance time ratio, sundry office expenses time ratio, travelers commission sales ratio. Because in generally travelers means that is related to sales agents actually. For the purpose of selling the items, they might traveling here and there. Okay, that is nothing but travelers commission. Discount allowed, no doubt about it, sales ratio. Bad debt sales ratio. Director's fee only post. There is no direct involvement in the pre, so director concept itself is applicable in case of post. Tax audit fee based upon sales only. If it is statutory audit fee, only post. So that's why this is exists both in pre and post. Sales ratio. Depreciation on property, plant and equipment, again time ratio. Debenture interest based upon the no, only post, because debentures are there only if company is in existence. That's it, guys. Then you can work out, you will know the pre-incorporation period profits and post-incorporation period profits. If it is pre-incorporation period profit, then you can treat it as capital reserve. If it is loss, you can treat it as goodwill. If it is post-incorporation period profit or loss, you can transfer to the profit and loss account. That is the base discussion we made actually here. So the next question is for bonus issue, guys. What the question is, let us have a look. You know the concept of bonus shares. The basic issue is bonus shares we can issue to convert partly paid shares into fully paid up shares. For this process, you can issue the bonus shares. Yes, that is possible. And you can also issue the bonus shares if all the shares are fully paid up. Actually, the provision in Companies Act 2013 is if all the shares are fully paid up, then only you can able to issue bonus shares. Now, through issue of bonus shares, you can convert partly paid up shares into fully paid up shares as well. Why I'm differentiating these two scenarios? In this scenario, you can utilize only general reserve. I mean, what is that? Free reserves. General reserve or P&L means you can utilize only free reserves. In case of issue of bonus shares and fully paid up shares, you can utilize free reserves. You can utilize securities premium. You can also utilize capital redemption reserve as well. This is the base concept you should need to remember in case of bonus shares. Now, what the question is all about, let us read first. Raise Limited with subscribed capital of 7,50,000 consisting of 75,000 equity shares of rupees 10 each, called up capital 7.50 per share, which are partly paid up shares. Indirectly, they are conveying. Okay, 75,000 into 2.5 is the amount which actually, if they want, they can call from the 75,000 equity shareholders. A bonus of 1,87,500 rupees declared out of the general reserve to applied in making the existing shares fully paid up. 2.5 multiplied with 75,000 shares means, which is equal to 1,87,500 only. If you observe, this concept is related to conversion of partly paid up shares into fully paid up shares through issue of bonus shares. At that point of time, you can utilize only free reserves. That's why general reserve is a free reserve you can utilize. Now you need to provide the journal entries at that particular scenario. Sir, can you please let me know, guys, all of you, what is the journal entry? First, whenever the bonus shares concept is there, you should need to put aside the existing reserves to bonus to shareholders. That is bonus to shareholders account data to general reserve account. I'm so sorry. One second. Yeah, general reserve we need to reduce general reserve to bonus to shareholders account. How much? 1.875 lakh. Fine. Now you can make a call from the partly paid up shareholders by passing the entry share call to share capital account. That is equity share call to equity share capital account. That is how much? Again, 1,87,500. Now we are not getting any single rupee from the shareholder. This share call should be knock off with the bonus to shareholders by passing the entry bonus to shareholders account data to share call account. These are the entries. If you want, you can cross check with the printed solution as well. That is general reserve to bonus to shareholders, share call to equity share capital, bonus to shareholders to share final call. Now come to the second scenario. A limited company having fully paid up capital of 75 lakhs consisting of equity shares of rupees 10 each. That is 7,50,000 equity shares had a general reserve of so and so. It was resolved to capitalize 7,50,000 out of general reserve by issuing 75,000 fully paid up bonus shares of rupees 10 each. Each shareholder to get such share for every 10 shares held by the company. Same to same entries, a small modification. This entry is same, general reserve to bonus to shareholders. Amount is different, which was 75 lakhs right now. Now there is no share call entry. Now there is no share call entry. The entry is just a moment. There is no share call, there is no call entry, that is directly bonus to shareholders account data to share capital account will come directly. That is the only difference. If it is conversion of partly paid to into fully paid up, share call entry will come as additional entry. So this is the final. In case of conversion of partly paid into fully paid up, bonus to shareholders should be knock off with the share final call. Here we can directly transfer to the share capital itself. Hope these are the basic items. Hope you understand these are the basic items only. Next, issue of right shares. What they're asking, calculate the value of the right. In the right shares concept, the only one problem available is knowing the value of right. How to know the value of the right? Cum right share price minus X right share price. What is the meaning of cum right share price? What is the meaning of X right share price? Before issue of rights, the existing market price of the share is cum right. After issue of the shares, the market price of the share is known as X right share price. Now it was directly given the market value of the share is 360. Before issue of right shares, market value was 360. Now you need to calculate X right share price. First, let me read the information given in the problem. Meta Limited has decided to increase its existing share capital by making rights issue to the existing shareholders. Company is offering one new share for every 2 shares held by the shareholder. If existing 2, they are ready to issue 1 right share. The market value of the share is 360 and the company is offering 1 share of at the rate of 180. Right share is issued at 180. Calculate the value of the right. Do you know the formula for X right share? We already discussed. The formula for X right shares are total value of the existing shares. Total value of the existing shares means first existing shares to each share value 360 plus we are getting 1 right share for every 2 shares. That is proceeds from right shares. How much in generally company is getting money? Proceeds from right share 180. 1 share 180 divided by total number of shares after right shares, after issue of right shares 3. The theoretical X right share price or X right share price formula is existing value of the shares plus proceeds from right shares divided by total number of shares after issue of rights. Now, may I know the final figure of this? 2 multiplied with 360, 720 plus 180 divided by 3, which is equal to 300. So the difference between 360 and 300 is nothing but 60 is the value of the right. If you want to cross check, you can cross check this. The value of the right is 60 per share. That's it, guys. This is all about right shares. Then come to redemption of preference shares topic. Which question they tested? Let us have a look. The question is, show the journal entries in the books of the company. Just they require the journal entries for the given scenario. What is that scenario? Dheeraj Limited. Sir, for redemption of preference shares, what the base concepts are? I'll tell you first the base concept, then let us have a discussion about this problem. One thing, guys, the redemption of preference shares may happen in two ways. Redemption from existing resources or redemption from fresh issue of shares. If the redemption happened through existing resources, then you should need to transfer face value of the preference shares redeemed to capital redemption reserve. If through fresh issue of the shares, if the redemption happen, no need to transfer any amount to the CRR. That is the base concept. With that background, let me read the problem. Dheeraj Limited had 5,000 10% redeemable preference shares of rupees 100 each fully paid up. The company had to redeem these shares at a premium of 10%, redemption at premium. It was decided by the company to issue the following: 40,000 equity shares of rupees 10 each at par. Out of this 5,000 into 100, out of these preference shares, they are issuing 40,000 equity shares at the rate of 10 rupees each at par, means certain portion of the preference shares redeemed through issue of equity shares. Sir, this is altogether irrelevant because the proceeds from issue of debentures should not be utilized for redemption of preference shares. Only fresh issue of shares proceeds only you can utilize. Just this is additional information, but nowhere this amount is available for redemption. The issue was fully subscribed and all accounts were received in full. The payment was duly made. The company had sufficient profits. Show the journal entries in the books of the company. Now, first of all, my question is, how much amount I can transfer to CRR to the extent of utilization of existing resource? Am I right? The total face value of the preference shares redeemed were 5,000 into 100, which was 5,000 into 100 means 5 lakhs. Out of this face value of the preference shares, through issue of fresh equity shares, happened for 4 lakhs extent. The remaining balance you can redeem through existing resource. That is 1 lakh. This 1 lakh amount only you can transfer to the CRR. Am I right? Sir, then what about the journal entries, sir? The first and foremost journal entry. Now the existing preference shares, you can make it transfer to preference shareholders. That is 10% redeemable preference share capital. Amount 5 lakhs and a premium on redemption of preference shares. Because the preference shares are redeemed with premium, that is 50,000 to preference shareholders, 5.5 lakh. Am I right? Then this premium on redemption of preference shares, you can set off with P&L account, guys. You know such concept, but don't use the other resources like securities premium, because there is a clear-cut provision I already discussed in the main lectures. Those companies which follow the accounting standards, they may not utilize the securities premium to set off the premium on redemption of preference shares or premium on redemption of debentures, whatever the case may be. So that's why this premium always you can set off with free reserves only. Okay, just wait. In the next entry, we can make set off. First, for such preference shareholders, you can pay the amount to bank, which was 5.5 lakh. Now you can set off the premium with P&L, that is P&L to premium, that is 50,000. Don't forget to transfer 1 lakh amount to the CRR. To creation of CRR, you can utilize any of the free reserve as your wish. So just I'm writing P&L to CRR or any other general ledger or anything is there, you can utilize. Those are the normal entries you need to pass. Before that, I forgot one entry, which is issue of equity shares and issue of debentures entry also you should need to write now. Those are also happen now. That is bank to equity share capital, bank to 12% debentures. These are not related to redemption entries. These are related to issue entries. That's it. So first entry bank to equity share capital, second entry bank to 12% debentures. Next, redemption transfer to preference shareholders payment. Then premium on redemption of preferences cancelled with P&L. Then CRR created. Over. Go up. So the next chapter is all about redemption of debentures. Concentrate. Sir, in redemption of debentures, actually we learned so many scenarios. I mean, scenarios means, sir, redemption of debentures happened in lots. Yes. Redemption of debentures may happen through preparation of debenture redemption reserve. Redemption of debentures may also happen through conversion. Or redemption of debentures automatically happen, that is automatically repaid as on maturity date. These are just different scenarios. Now, by seeing the problem information, which scenario is suitable, let us have a look first. XYZ Limited has issued 1012% convertible debentures of 100 each, redeemable after a period of 5 years. Okay. According to the terms and conditions of the issue, these debentures were redeemable at a premium of 5%. The debenture holders also had the option at the time of redemption to convert 20% of their holdings into equity shares of rupees 10 each at a price of rupees 20 per share and the balance in cash. Now, what is the option? Option is 20%. They can go for conversion. That is the option given by the company. Option is 20%. They can go for conversion. Okay, fine. Now, this is the information. This is the, computational information useful for this problem. Concentrate. Debenture holders amounting 20,000 rupees opted to get their debentures converted into equity shares. Sir, rupees 20,000 means 200 debentures. 200 debentures opted. If 200 debentures opted for conversion means out of the 20% will only eligible, because it was clearly given that once if certain debenture holder go for conversion, then as per the scenario given, how much percentage they can able to convert? 20% only. Here 200 debenture holder, 200 debentures persons are willing to go for conversion. But whenever such 200 debentures willing to go for conversion, out of which 20% is only eligible now, it was given. That means if they are opted, debenture holders amounting 200 debentures opted to get debentures converted into equity shares as per the terms of issue means 200 into 20% means 40 debentures only we can going to convert into equity shares. Sir, what about the remaining 80%? Sir, for the remaining 80% we may pay cash directly. Calculate the number of shares issued and cash paid for the redemption of rupees 20,000 debenture holders. It is very much easy. Concentrate all of you. For 40 debenture holders, we are issuing equity shares. 40 debenture holders means 40 into debenture holder face value 100. Always redemption happened at 5% into 105%. That is how much worth of equity share we need to pay? 40 into 100 into 105%. 4,200 worth of equity shares I need to issue. Each equity share price was 20 rupees. It was given. Equity share price 20, face value 10. 4,200 divided by 20. How many number of equity share I need to issue? 4,200 divided by 20. I need to issue 210 equity shares. Number of equity shares for 210. What about cash share? Cash 200 into 80% means 160 debenture holders. For 160 debenture holders, cash means 160 into 100 into 105%. How much it is? Once again. 80% cash means this 160 holders plus total 1000 debentures na. Out of 1000, we considered already 200 na. Remaining 800 also I need to add. That means total 960 debentures. 960 debentures we are going to pay in the form of cash. Now 960 into, do you understand? 80% means not only this 200 into 80%, for the remaining 200 only go for opted. What about the remaining 800? 800 straight away go for the cash. That 800 plus 160, total 960. For such 960 debenture holders, we are paying cash. That is 960 into 100 into 105%. How much amount is coming? Just you can put it under cash. You can cross verify the answer here, guys. So number of debentures were 210. Calculation of cash to be paid for 160 debenture holders. If you calculate only for 160, which is 16,800, in the answer just given for 160, let me read the question clearly. You are required to calculate the number of shares issued and cash paid for the redemption of, oh, in the question it was clearly given, na? I'm so sorry. Redemption of 20,000 debenture holders, how much shares you are issued, how much cash you are issued. That means he's not talking about the remaining 800 debenture holders. He's only talking about 160 only. I'm so sorry. It was clearly given, na? Cash paid for redemption of 20,000 worth of debenture holders. That means out of such 200 debenture holders, 20% in the form of equity shares, remaining 80% in the form of cash means you can consider only 160. 160 into 100 into 105%. That's it, guys. It's very easy. There is no tricky point here. There is only one thing you need to understand. Debenture holders 20,000 means 200 debentures, 20% equity shares, 80% is cash. How many equity shares you need to issue? How much cash you need to issue? That's it. Come down, guys. Which is related to problem number 9, investment accounts. Sir, is it fixed income bearing securities or variable income bearing securities problem, sir? Which is fixed income bearing securities. How you know? The given investments are debentures. Sir, same problem we already done in our classroom. Just for your sake of convenience, I'll read the crux. Alpha Limited purchased 5,000, 13.5% debentures of the face value 100 each of Pargot Limited on 1st May 2021 at the rate of 105 on come interest basis. Investment accounts, in your mind, the format should need to come particulars. Then, tell me, guys, all of you, quotation price, sorry, face value, interest, cost, purchase to bank, face value 5,000 into 100, interest from the last date of payment to up to date of purchase. We don't know, still we not a trade. Cost price. If it is the commenter's quotation price minus interest is the cost. Am I right? The interest on these debentures is payable on 31st and 30th of March and September respectively. That is 31st March is one due date, 30th September is another due date. On August 1st, 2021, again company purchased 2,500 debentures on come interest basis. On October 1st, company sold certain debentures on ex interest basis. Market value of these debentures as at the close of the year was 106, which is the closing market value of investments. We are required to prepare the investment in debentures account in the books of Alpha Limited for the year ended 31st December 2021 on average cost basis. Average cost basis means at the time of sale of these 2,000 debentures, you can presume that, sir, is it these debentures sold out from lot number 1, that is these 5,000 debentures, or lot number 2, 2,500 debentures? We need to assume on average they sold. If it is given that FIFO, then we can presume that these 2,000 debentures are sold out from lot number 1. If it was given LIFO, then we can presume that these 2,000 debentures were sold out from lot number 2. So it was given average cost basis means on average, these 2,000 debentures sold out both from lot number 1 and lot number 2. Okay. Sir, I'll explain this entire question through the printed solution because a lot of computations are involved. I don't want to waste my time on the computation part. Please concentrate. So the typical investment account format: date, particulars, face value, interest, amount, both on debit side as well as credit side. Due dates 31st March, 30th September. We purchased as on 1st May 2021, 2 bank, face value 5 lakh. Interest you can calculate from the date of purchase to last date of payment. Last date of payment may be 31st March. 31st March to 1st May means only 1 year. That is 5 lakhs into 13.5% into 1 by 12, which is 5625. The interest calculation was clearly given. You can also show in the bracket as well. Now the commenter's quotation price was given at 5,000 into 105. 5,000 into 105 minus 5625. Then you will get the cost of the investment, which was 5,19,375. Again, I am repeating how you know the cost of investments. 5,000 into 105 minus the interest component 5625, which is 519,375. That is the first transaction posting. Next, on 1st August 2021, another purchase made, 2,500 debentures, face value 2,50,000. Interest, last date of payment up to date of purchase. Last date of payment 31st March to 1st August. April, May, June, July, 4 months. So 2,50,000 into 13.5% into 4 by 12. Here it was worked out, which was 11,250. Now again, the given quotation price is the commenter's quotation price. So 2,500 into 102.5 minus interest component 11,250. So 2,45,000 is the cost of investment. In chronological order, as on 30th September, you may get the interest. Now you are getting the interest on both the lots, 5 lakhs plus 2,50,000, which was 7,50,000 into 13.5% into 6 by 12. 50,625. So there itself clearly given 5 lakhs plus 2,50,000, 7,50,000 off months interest, 50,625 is the interest. At the time of getting the interest, the entry is bank to interest. Under credit side, just they shown for 6 months interest. Then if you go the chronological order, on October 1st, 2021, company sold 2,000 debentures, sale value 103 each on X interest basis. Just the sale value was 2,000 into 103. The sale proceeds were 2,06,000. Whenever sale transaction occurred, you need to find out profit or loss. This is the sale. What is the purchase price, sir? Sir, to know the 2,000 debentures purchase price, you should take the first this total cost. 5,000 plus 2,500, 7,500 debentures total cost was, add these two components, 519,375 plus 2,45,000. 7,500 debentures cost was 7,64,375. Then for 2,000 debentures cost was how much? Work out this. I got 2,03,833. This 2,03,833 is the average cost of the investment sold. So 2,03,833. This is the cost price. Now the difference is profit. The difference is profit, which is 2,167 is the profit. Now, what is the entry, sir? Please all of you concentrate. The entry bank account at are 2,06,000 to investment account 2,03,000, or you can pass two entries as well. Just a second. The entry is bank to investments, investment to P&L. Now bank to investment 2,06,000 and investment to P&L 2,167. These two entries just they got posted. Bank to investment under cost column by bank 2,06,000. Then under investments to P&L under 2 P&L cost column 2,167. This is the posting for the sale of investments and also calculation of profit and loss as well. Fine. come down. The final transaction is pending, which was carrying value of the debentures at 106. Out of 7,500, we already sold 2,000. Only 5,500 debentures are there. So 5,500 into 106, guys, which is 5,60,542. If you want, you can calculate 5,500 into 106. 1 second. Sorry, this is market value. This is not the cost value. This is given the market value. Why is it they are given the market value? You need to compare the cost value with the market value. At whichever is lower, you need to work out. The cost price was 5,60,542, which is the balancing figure actually. The cost price is 5,60,542 and the market price is 106. 106 into 5,500, which is 5,83,000. Whichever is lower means at cost price only we need to carry. That's why cost price only recorded. For example, if the market price is 102 rupees, let us assume if it is 102 rupees, then the value will become even 101 also more 100. Let us assume 100. Then 5,500 into 100. Then it will become 5,50,000. Just I'm giving different scenarios, guys, for better understanding. If that is the case, if market price is 100, then cost or market price, whichever is lower means at market price only. Then you need to carry at 5,50,000, and the difference also you need to provide as a loss, which is 10,542. Do you understand? So, but here in this case, the market value is more than the cost price. That's why we are simply carrying it cost price only. No need to report any profit or loss on valuation of investment. Hope you get it. And one more thing, guys. Sir, what is this interest, sir? This is interest accrued from the last date of payment to up to the closure of the financial year. Last date of payment is 30th September. Na? 30th September to December 31st, you need to pass one entry. Na? That is interest accrued account data to interest account. Which is interest account, na? Which is by balance carried down, which is interest accrued. How they worked out? 5,500 into face value 100 into 13.5% multiplied with September 30th to December 31st. 3 months divided by 12. You can work out, it will come 18,563. Then if you close the account, then the balance under interest account, interest column, you can transfer to profit and loss account. Then investment account automatically got tallied. Here, guys, most of things I simplified and no content was given with respect to the computation. Just believe me, here I am only focusing on the technicalities. I'm not focusing at all on any computation part. Come back. Fine. Sir, this problem, insurance claim for loss of stock, same to same problem was already discussed in our classroom. This is related to abnormal stock and normal stock. Both are available now. Do you remember all of you? The same question. Just a second. I'll open that. Then you will believe me. Sir, without reading question, how we know, sir? I do agree. Just first let me open that. The same question. Yeah. Which is insurance claims. Here you are seeing normal and abnormal, right? Normal and abnormal. The same question with different items. How you know which is normal and abnormal items related? Please concentrate. Come down. While valuing the stock on 31st March 2022, 1,000 had been written off in respect to certain slow moving items of costing 4,000. Sir, what here they required, sir? Compute the amount of claim of stock destroyed by fire to be larger to the insurance company. Also prepare memorandum trading account for the period 1/4/2022, 27/7/2022 for normal and abnormal items. Okay, so the similar question is available, which is clearly given in question number. Just a moment. If anyone have, just I'm giving the reference. Just I want to skip this question. That is the reason I'm providing the information. Problem number 4 of our material. So which is problem number 4 as it is problem. Sir, remaining questions also what I told in the different chapters, such questions also similar questions we made. But anyway, this is a straight away question. I also exhausted. So that's why just I'm giving the reference similar to problem number 4. Just leave it, guys. If you have any doubt, you can directly contact with me. Right, guys, let us move quickly. Only 3 pending chapters are there. There is problems from 3 pending chapters. One is departmental, another one is branch, another one is incompleted. So related to departmental accounts, I'm so sorry. Before that, one more is also there. Hire purchase. Okay. Total 4 chapters are there. Related to hire purchases, what is the problem? Lena Transport Limited purchased from Ethnic Motors. Hire purchaser, Lena Transport Limited, Ethnic Motors, hire vendor. 4 tempos costing 2,75,000 each. On hire purchase system on 1/1/2020. 4 multiplied with 2,75,000, 11 lakh. Payment was to be made 2 lakhs down. And the balance in 3 equal annual installments payable on 31st December 2020, 31st December 2021, 31st December 2022, together with interest at the rate of 12% per annum. Now, out of 11 lakhs, if 2 lakhs is the down payment, 2 lakh will be the down payment, DP. The remaining outstanding cash price was 9 lakhs. This 9 lakhs, they are going to pay in 3 equal annual installment, 3 lakh, 3 lakh, 3 lakh, along with interest component. Okay. Lena Transport Limited charged depreciation at the rate of 10% per annum on the WDV method. It paid the installment due at the end of the first year, but could not pay the next on 31st December 2021. There is a default in the second installment. Default in second installment. Whenever there is a default in a particular installment, hire vendor have a privilege to repossess such goods. As a result, Ethnic Motors decided to take over 2 tempos and to leave the other 2 tempos with the purchaser on 1/1/2022. The repossession is partial repossession, which is not a full repossession, which is a partial repossession happened. Against the amount due on 31st December 2022 are due to the reason of not paying the installments on the 4 tempos which related to the second installment. Hire vendor Ethnic Motors repossessed 2 tempos and left 2 tempos with the Lena itself. The tempos taken over were valued on the basis of 15% depreciation annually, which is the agreed value of the repossessed goods. Agreed value of RPG, repossessed goods, as on 31st December 2021. Show the necessary accounts in the books of Lena Transport Limited for the years 2020, 2021, 2022, assuming the balance was paid to Ethnic Motors Limited on 31st December 2022. They're asking to show the general ledger or ledger accounts under hire purchaser books. One thing you need to remember, guys. Let me move on into my OneNote. Just a moment. I want to explain a small concept here. That's it. Whenever you are discussing the concept of partial repossession, as on the date of repossession, what you need to check? What is the book value of the goods? Book value of repossessed goods in hire purchaser books. You need to compare this book value of repossessed goods with agreed value of the repossessed goods. For example, in this case, what is the book value of the repossessed goods, sir? It's very easy. The original cost was 11 lakhs, right? They are providing the depreciation at the rate of 10% per annum, right? In hire purchaser books, the original cost was per one tempo we need to check, not for all tempos for one tempo, because two tempos only repossessed, right? So book value of the repossessed goods, one tempo 2,75,000. 1 second. And for two tempos multiplied with 2, and the book value means they might already provide a 10% depreciation for 2 years. That is into 90% into 90% is the book value. But the agreed value as per the higher purchaser, sorry, as per the higher vendor told that I will value such repossessed goods as on that date was 15% depreciation. That is 2,75,000 multiplied with 2 years into 85% into 85%. Sir, what is this two figures, sir? What is these two figures means? First, let me put some values, then I will tell you. I will give the analytical explanation to such values. Which here it is 4,45,500. $3,97,375. Now concentrate. What this is all about. In higher purchaser point of view, the worth of goods were 4,45,500. The worth was 4,45,500. If they want to resell in the outside market, they will get 4,45,500. But right now, higher vendor is communicating to the higher purchaser that I will buy such repossessed goods at the rate of 3,97,375 only. The difference of book value and the sale value is loss of repossession to whom? Higher purchaser. How much is the difference? 4,45,500 minus 3,97,375. The difference is 48,125 is the loss of repossession. If this concept is there in your mind, then remaining all are simple cut, copy, paste. Now, let me explain the problem through my printed solution. All of you, please concentrate. Sir, show necessary accounts means anyway we need to open higher vendor account as well as higher purchase asset account. That is Tempos account as well as higher vendor account. So one is Tempos account. Just come down. This is Tempos account, and this is higher vendor Ethnic Motors account. Sorry, Ethnic Motors Limited account. Now we can start the problem from 1/1/2020. At the time of purchase of higher purchase asset, what is the journal entry, guys? Ethnic Motors. Sorry, what is that asset? Sorry, Tempos account debtor to Ethnic Motors account. Tempos account debtor to Ethnic Motors account. That is the entry we need to pass. Tempo account debtor to Ethnic Motors account at the rate of cash price 2,75,000 multiplied with 4, which is 11 lakhs. Then after recording this entry, immediately we will pay the down payment. Whenever you are making the down payment, then higher vendor to bank. That is Ethnic Motors to bank down payment. Then at the end of the first year, that is as on 31st December 2020, first you need to work out the interest. That is interest account debtor to higher vendor. Interest account debtor to higher vendor. That is 9 lakhs is the opening balance now after making down payment. On 9 lakhs, it is 12% means 1,08,000. So then how much amount you need to pay as a first installment? 3 lakhs plus that 1,08,000. That is Ethnic Motors to bank 4,08,000 they paid, and the balance was 6 lakhs. And for the asset account, they are providing the normal depreciation on 11 lakhs into 10%, 1,10,000. The remaining will be the balancing figure to balance brought down. Now coming to the second year ending. Now at the end of the second year, again, higher vendor should need to charge the interest as an expenditure. Now the interest will be charged on 6 lakhs, guys. 6 lakhs into 12% is 72,000. That is interest account debtor to higher vendor account 72,000. Now as a part of part payment, they should need to make payment of 3,72,000 originally. But they defaulted. Am I right, guys? Now consider it, all of you. Now, before applying the concept of partial repossession, you can also pass the depreciation entry here. That is second year depreciation for 99,000. Now all of you apply the concept just now what we have discussed in my OneNote. Sir, the book value of the repossessed goods was 4,45,000, but the agreed value of the repossessed goods was 3,97,375. Now, with this value, I need to reduce the vendor account. That is, higher vendor account debtor to Tempo's account, because Tempos were taken over by whom? Higher vendor. Just now we are selling such Tempos to the higher vendor at such value. Then in Tempos, buy higher vendor. In Tempos, buy Ethnic Motors, 3,97,375. The same figure just now made 3,97,375. Now, after passing this, you need to recognize profit or loss as well. Na? The difference, how much loss due to such repossession, due to such sale, how much? 48,125. Such one also you made. This is the accounting treatment for partial repossession. The remaining balance of two Tempos was 4,45,500. You need to carry forward here. The simultaneous postings also you should need to give in the Ethnic Motors. There is an Ethnic Motors two Tempos. If it is in Tempos, buy Ethnic Motors, then in Ethnic Motors two Tempo 3,97,375. Now, after completion of repossession, still how much balance I need to pay? 2,74,625. It was clearly given in the problem that the entire balance was settled as on 31st December 2022. So that's why you can provide the next year interest, that is by interest. Then you can settle the total amount in a single instance as on December 31st, 2022. Then for the last year depreciation also you can provide, then carry forward the remaining balance of the Tempos, remaining two Tempos balance there. That's it. So here the crux of the entire problem is only this part. I explained in a OneNote now. If you able to recollect such points, the remaining all are simple basic accounting treatment. Fine, guys. Come back. Guys, one request from my side. After completion of the entire syllabus and the entire video lectures and entire revision part only, please all of you watch these lectures. The reason I will tell you, you can able to recollect once you will have a good grip on the entire content or the concept. Otherwise, you may not be with in the same pitch. You may not be in the same line. Okay, because the things are very much vast. Sometimes I'm traveling here, sometimes I'm traveling there. Very basic information only I'm touching. So otherwise it will create so many problems to you. You may not be appreciable at that point of time. Okay. So it's my sincere request. Please all of you watch the RTP lectures after completion of the entire stuff only. Fine, guys. The next problem is towards departmental accounts. Which problem they are testing here? Let me check. Finally, prepare departmental trading and profit and loss account for the year ended 31st March 2022. Just the required departmental trading and P&L. What is the given information? Opening stock given, purchases, wages, sales, closing stock for department Y given separately, department Z given separately. We can easily prepare trading account with this information. Other expenses given, all expenses are to be allocated between the departments in the ratio of their gross profit. Okay, that means we need to calculate the GP. Then based on GP ratio, salaries, rent, advertisement, general expenses, depreciation, we can simply apportion. Generally in the classroom, what we have discussed, based upon the nature of expense, certain base they might given. For example, salaries, employees in the different departments, they may given. For the rent, they may given the rent space. In square feet, they might given. But here simply they are putting some sentence for the purpose of allocation of all these expenses. Do you understand? Just you can follow the information given in the problem. We can simply allocate these expenses based upon the GP. Now, come down. Department wise sell goods to department Z. Interdepartmental transfers. Interdepartmental transfer stuff is share. At a profit of 25% on the sales. Department Z sells goods to department Y at a profit of 28% on the cost. If you observe, this percentage they expressed on the sales, but this percentage they expressed on the cost. Convert this percentage and also on sales. On how much percentage would be? Or if you want, you can just follow. Just remember it is on cost. I think so. It is always advisable. Just let me convert this 28% on the sales. How much? If it is cost is 100, profit is 28, then the selling price is 128. 28 by 128 is the percentage on the sales. 28 by 128 means how much percentage? 21.875. which is 21.875% on sales. Fine. Each department manager is entitled to 10% commission on net profit subject to unrealized profit on departmental sales being eliminated. What he is telling, whenever interdepartmental transfers are there, and the transfer price is more than the cost price, then the department in which certain closing stock is available and such closing stock was arised due to making transfer of such goods from the transferor department to the transferee department, then unrealized profit lying in such closing stock should be eliminated in the form of stock reserve. After adjusting such stock reserve, how much net profit is there? Based upon such net profits, departmental manager will get 10% commission. That is the point he is telling. Okay. Stock transfer during the year from department Y to department Z was 40,000 and from department Z to department Y was 50,000. These are interdepartmental transfer amounts were given. Closing stock includes transfer from department Y to department Z 12,000 and from department Z to department Y 21,200. Opening stocks do not include any interdepartmental transfers. Only closing stock only involved. Why this point was given? Only closing stock reserve is there. There is no opening stock reserve. Prepare departmental trading and P&L account for the year ended 31st March 2022. So the problem is pretty much easy, provided you need to understand from this paragraph, this line to this line. This is very much easy. Nothing. This is the basic stuff. This is the advanced stuff. Just they mix it the problem. Just they send an arrow. Now, sir, for the basic stuff, there is no much explanation from my side. You know everything. First, let me put the solution. Then the basic stuff, just the copy paste. Concentrate. Opening stock, purchases, wages, sales, closing stock. Up to this, everything is there. Now, related to salaries, rent, advertisement, general expenses, depreciation, don't go at this moment because we need to know the GP first. Because based upon the GP of that particular department only, we can apportion these expenses. Just wait for some time for apportionment of these expenses in between department Y and department Z. Now, interdepartmental transfers are happened. Na? What happened? Y to Z, 40,000. That means for Y it is sales. For Y it is sales. For Z it is purchases. Do you understand? This 40,000, this 40,000. In the same way, Z to Y 50,000. For Z 50,000 are sales. For Y 50,000 is purchases. That is the treatment for interdepartmental transfers in trading account. Now you can work out the gross profit. You know the gross profit ratio, which is 32:23. GP ratio 32:23. You can apportion all these expenses in 32:23 in between Y and Z in P&L account. Salaries, rent, advertisement, depreciation up to this. Then you will get the net profits. Am I right? Now, one thing need to remember, these net profits are before adjusting stock reserve or after adjusting stock reserve. Till now, we are not adjusted any stock reserve. Na? These are before adjusting stock reserve. These net profits are before adjusting stock reserve. Now, to know the manager's commission, first you need to adjust the stock reserve. What is the meaning of stock reserve? Stock reserve is nothing but unrealized profit lying in the closing stock. Now concentrate. Here two departments are there, Y, Z. Now, closing stock includes transfer from department Y to department Z, 12,000. These 12,000 worth of goods transferred from Y and transferred to Z. These are lying in the closing stock of Z. To whom it is an unrealized profit? For Y it is an unrealized profit. Now, how much percentage actually we are included from Y sold goods to Z? 25% on the sales. That means on this 12,000, you need to apply how much percentage? 25%. That is 12,000 into 25%. That is 3,000 is the stock reserve in Y department. For that, P&L to stock reserve, you need to provide in department Y. The similar mode, it was also given that department Z to department Y 21,200. Consider all of you. Just I'm rubbing this. So 21,200 closing stock is there in department Y, which was transferred from whom? Department Z to department Y. Z to Y, how much percentage they are adding as a profit? 21.875% profit on sales. So this 21,200 is at selling price. You can apply 21.875%. That is the reason why I previously told to convert that percentage on the profit. Or if you want, you can apply like this 28 by 128 also. Nobody will object you. Now how much? 21,200 into 21.875%, which is 4637. Such 4637 was given here, which is unrealized profit for department Z. Now, after noting such stock reserve, may I know the profits here? 22,200 minus 300. 22,200 minus 3,000. 19,200. On such 19,200, 10% commission is 1920. Here also in the same way, 13,800 minus 4638. After that, the profit is 9162 into 10%, which was 916. Remaining will be the net profits. That is the point. Just they asked. We calculated the manager's commission, we calculated the stock reserve, and we prepared the trading and P&L account. Over. Sir, we done this part as a separate problem. We done basic part as a separate problem in the classroom. But just they combined, just they tested in the RTP. That's it, guys. Fine. Next, this is accounting for branches. What they asked in the branch accounts. Sir, in branch accounts, they directly tested the foreign branches. No headache itself. Foreign branches, direct question and simple question. And one thing related to foreign branches, you need to check. Is it integral foreign operation or non-integral foreign operation? Why, sir? In case of integral foreign operation, at the time of conversion, any difference in trial balance will occur. You can treat it as, or you can transfer such foreign currency, such loss, that foreign currency loss, you can debit to P&L. But if it is the non-integral foreign operation, you can need to transfer to foreign currency translation reserve. If it is the profit, it is the positive figure. If it is the loss, it is a negative figure. You should be need to carry forward in the reserves and surplus. That is one difference. And one more difference. If it is integral foreign operation, you need to check monetary items and other items. Am I right? If it is the monetary items, you need to apply the closing rate. If it is the other items, except these two, that is one PPE, historical cost, that is the rate which was given as on date of purchase, and the inventory, the rate which was given as on date of valuation. These two rates are specifically usable. For the remaining all items, again closing rate. Again closing rate. For these are balance sheet items. For balance sheet items. For P&L items, always average rate. For non-integral foreign operation, there is no difference between monetary and a non-monetary. For balance sheet items, closing rate. For P&L, average rate. The only one difference is if it is integral foreign operation, PPE and inventory, the rates might differ. You need to check if any rate which is there in the problem as on date of purchase of such PPE, you should need to use such rate. Any rate which is available as on date of valuation of inventory, such rate you need to use. And depreciation on PPE also the same rate you need to use in case of PPE, except that there is no difference between integral foreign operation, non-integral foreign operation. Okay. So I don't want to give much discussion on here because a lot of problems we already done in the classroom because the problem was big, but nothing is there. This is the base concept. Please, all of you remember such concept and apply that, which is the similar problem what we was done in the last but one problem in the branch accounts. If anyone want to provide as a reference, you can take it as a reference. That's it, guys. That is related to branch accounts. Next, come to accounts from incomplete records. Always they're asking to provide uh, trading and P&L as well as balance sheet, right? Prepare trading and P&L as well as balance sheet. All the working should form part of your answers. Let me read the problem. So you know always the incompleted records problem is a jackpot problem. Sometimes which is testing time for you, your analytical attitude as well. Please concentrate. Let me read the information given in the problem. Aman, a ready-made garment trader, keeps his books of accounts under a single entry system. On the closing date, that is on 31st March 2021, his statement of affairs stood as follows. Aman's capital given: loan, creditors, building, furniture, motor car, stock, debtors, cash in hand, cash at bank. Riots occurred and a fire broke out on the evening on 31st March 2022, destroying the books of accounts. On that day, the cashier had absconded with the available cash. You are furnished with the following information. Sales for the year ended 31st March 2022 were 20% higher than the previous year sales. First of all, you need to decide the previous year sales. If you know the previous year sales multiplied with 120%, then you will know the current year sales. Out of the current year sales, 20% are for cash. And remaining 80% are for credit. That means the base point is here. If you know the previous year sales, you know the current year cash sales, you know the current year credit sales. You know the current year cash sales, you know the current year credit sales. If you know the previous year sales. He always sells his goods at cost plus 25%. He always means in the current year, in the previous year, in future also. He is always selling the goods at 25%. Cost plus 25%. If the cost is 100, profit is 25, selling price is 125. There were no cash purchases. That means all purchases are only on credit. Okay. Collection from debtors amounted to 14 lakh, out of which 3,50,000 was received in cash. Remaining a bank. 14 lakh minus 3,50,000 means through bank 10.5 lakh. That is the point indirectly he is conveying. Business expenses amounted to 2 lakhs, of which 50,000 were outstanding on 31st March 2022 and 60,000 paid by checks. Now, the total business expenses 2 lakhs, outstanding 50,000. That means remaining 1.5 lakh paid, right? Out of this 1.5 lakh, 60,000 paid through bank, 90,000 paid through cash. That is the point he is conveying. Gross profit as last year's audited accounts was 3 lakhs. Oh, GP was given here, which was 3 lakhs, which is equal to 25. If GP is equal to 25, then for 125, which is how much? 125 into 3 divided by 25. 15 lakhs. Last year sales were 15 lakhs. If previous year sales were 15 lakhs, current year sales were 15 into 120%, 18 lakhs. If current year sales are 18 lakhs, out of which cash sales are 3.6 lakhs, then credit sales are 18 into 80%, 14.4 lakhs. Is it okay, guys? So this information provided, point number 4, provided information related to last year sales from which we can easily find out current year sales. Provide depreciation on building and furniture at 5% each and motor car at 2%. His private records and bank passbook disclosed the following transactions for the year. Payment to creditors, no need to tell paid by check like that because these all are only bank passbook transactions. Payment to creditors, personal drawings, repairs, traveling expenses, cash deposited into the bank, contra, cash withdrawn from the bank, which is also contra. Stock level was maintained at 3 lakhs all throughout the year. You can consider it as a closing stock. The amount deflated by cashier is to be written off to the profit and loss account. Now, after reading the information, how my mind will travel, you know. In trading account, opening stock information is there. Purchases not available, all are credit purchases. Sales information just now I found, which was 18 lakhs. Closing stock just now he's told that all over the year, which was 3 lakhs only maintained. That means through closure of the trading account, I may would get purchases as a balancing figure. Trading account balancing figure. Now, debtors, creditors accounts are there now under working notes. If I close the debtors account, I may would get closing debtors as a balance, because opening debtors is available, closing debtors balance is not available. If I post this purchases information, what I found through balancing figure under trading account to creditors account, then I may would get creditors account closing balance. That means debtors account, creditors account closing balances I may will get through debtors and creditors accounts under working notes. Like this, my mind should need to travel after seeing the information from the problem. This is also first time I'm seeing the problem as like you only. But our analytical mindset will think like that, guys. Sir, then something cashier had absconded something he was given. Na? We are preparing the cash book under cash and bank column, double column cash book. Na? Under cash account, if any balancing figure is there, which is the abnormal loss, which is cash absconded by the cashier, such abnormal loss you should need to represent under the P&L account as well. Okay. So apart from that, there is much points. There is no much points to discuss in detail. Okay. Sir, I always discussed in the classroom, whenever they ask a problem from incomplete records, all the statement you should need to open simultaneously. All the statement means first trading account, open. P&L account, I mean trading and P&L both are same only for you. Trading and P&L, open. Balance sheet, open. Working notes, all working notes one by one. Debtors, creditors, I mean, what is that? Cash book. Open all are separately. Read the information line by line. So that information impacts wherever in that all areas you can provide the adjustment simultaneously. Then automatically you will get, then automatically you will complete the entire information. Then which account should need to close first, you should need to know. Then close such account. Then you may get certain balancing figure, put that figure in another account. Then you may get balancing figure in the other account. Like that, you should need to complete the trading and P&L as well as balance sheet. Am I right? In that manner, I'll explain the entire problem through printed solution. Please all of you concentrate, come below. So just you can imagine I opened trading and P&L here. Just you can imagine. I also opened the current year balance sheet. Yes. Then working notes. First they open cash and bank account. Then debtors account. Then creditors account. That's it. These three are working notes. Now, let me read the information from starting onwards. Capital, where do I need to represent? In the balance sheet opening. Capital. Go to the balance sheet. Just a second. So balance sheet capital opening 4,80,000. Oh, 1 second. And how they are getting 4,80,000? It is only 3 lakhs only available, right? I'm seeing the wrong problem. Just a second, guys. I'm so sorry. Come up. Okay. Yeah. Capital here it is there 4,80,000. You can put 4,80,000. Next, loan 1,50,000. Just you can put loan 1,50,000. Creditors 3,10,000. Don't directly put in the balance sheet. Put in the working notes. Creditors by balance brought down 3,10,000. Okay. Then building, furniture, motor car. These three, after providing depreciation, you can put in the balance sheet. Provide a depreciation, put in the balance sheet. Simultaneously, depreciation also you can show in the P&L. Next, stock, which is the opening stock. Trading account, two opening stock you can put. Yes, just a second. Come down, come down. Don't confuse. So this is the opening stock. You can put 2 lakhs. Next, debtors. In working note, 2 balance brought down. Cash in hand, 2 balance brought down under cash book. Cash at bank, 2 balance brought down under cash book. Then come down, sales just now you calculated, which was 18 lakhs under trading account by sales. But out of which cash sales, you know how much, credit sales, you know how much. For cash sales, cash account debtor to sales. For credit sales, debtors to sales. That's why in debtors account to sales, this is 80% also you should need to work out. Entire sales portion information you should need to provide. So sales I work out here. Debtors account got impacted. So debtors account here, to sales, that is 14,40,000 remaining in the form of cash, that is cash sales 18 lakhs into 20%, which is 3,60,000. That is the first adjustment. Second adjustment, collection from debtors, bank cash to debtors. In debtors, by bank, by cash. In the cash and bank also simultaneously you should need to give the posting. Business expenses, entire expenses should transfer to P&L, that was 2 lakhs, and payments was made for 1.5 lakh through cash and bank. You can provide the accounting treatment. GP information was given only to reveal the previous year sales. Just ignore. Depreciation information was given to know the amount of depreciation. Next, all these transactions just to make it post in the cash and bank book. This is the closing stock put in the trading account as well as the closing balance sheet. Now, after checking what I should need to do, I close the trading account. If you check, I know everything about the trading account, including the gross profit, because gross profit rate was 20%. Now the purchases as the balancing figure, which was 15,40,000. So the purchases, if you know, in the creditors account, just to make it post such purchases, that is buy purchases 15,40,000. Then you know the closing balance of creditors, make it post in the closing balance sheet. Now in the similar mode, close the debtors account, then you know the closing balance of debtors, put in the closing balance sheet under asset side. Am I right? Close the cash account. Balancing figure will be cash deflated by the cashier, which is the abnormal loss. Okay. Then bank account might be tally automatically, or you know the closing bank balance, or you know the closing bank balance. The closing bank balance you can put into the closing balance sheet. Am I right? Now cash and bank account over. Now this cash deflated, you should need to make it post to the P&L account. Don't ignore that. Then close the P&L account. You may get the net profit for the current year. Such net profit you can add it to the opening capital. Then close the balance sheet. Automatically balance sheet will tally. This is the flow you need to adopt. Here I'm not telling each and every pinpoint. I told the flow. Just we discussed the technicalities. That's it, guys. So this is the end of incomplete records as well as RTP November 2022. Sir, still if you have any doubt regarding any chapter or any topic, you can feel free to contact me at any point of time. So all the best, guys. Hope you may qualify with flying colors in the forthcoming examinations, which are going to held in the month of November 2022. All the best. Have a nice day. Signing off, Satyaraju Kolluru.